Good day, guys. Welcome to Forex Walker. Welcome to episode 91. This episode is based on macroeconomics and nothing else. Let's check on things that happened previously and see how we can move forward with this episode. So here we have the U.S. inflation rate, and from here it says Jan is actually Fab, so we'll move. This is September. This is actually October. This is November. So basically, what is happening here is that we had a constant drop lower in inflation, which is generally an opportunity for the central bank or the Federal Reserve to cut rates, but they did not do that because they're expecting the inflation to drop lower toward the 2% benchmark. That's what Fed Chair Powell is, and this is toward the end of his term. We'll be having a new uh, chair in the Federal Reserve of the United States. So he's expecting a pick up, a bullish move from this 2.4%. He's expecting a bullish move higher to at least get 2.5 before we move lower. And the reason why he's expecting a move lower is because here we have the United States core personal consumption expenditure price index. They call it the PCE pressure index. It says core, that means it excludes energy and food prices. So here you can see that we got a bit higher. Here it says December, but it's not December, it's actually the month of Feb. And they got a bit higher, and that is the belief that Chair Powell went forward with to expect a pickup in inflation here. And that is not the only reason. Here it says United States Consumer Price Index, that is the CPI, that is known to you as the CPI. We got a bit higher, and that was also recorded in Fab, and that is the reason why he's expecting a bit higher from 2.4% to remember these are leading economic indicators. They're telling you about what will happen to the inflation in the future. The inflation is telling you what happened in the past, but here these economic indicators, the CPIs, they tell you what will happen in the future to the inflation. So basically what they're telling us is that inflation will uh, give us a bit higher. At least we might get a 2.5%. And when that bit higher happens, the currency will appreciate. So let's move on. Here we have the unemployment rate, and here it says Jan is actually Fab, and previously they had a 4.5% of unemployment. In the United States, they got a drop lower. That was 4.4%. We went to 4.3%, and this is a steady drop. It doesn't tell you what is happening now. It's telling you what will happen to inflation. It tells you that the currency will appreciate in the future. That is, and here, let's look at the GDP. The GDP is meandering between 2.1%, 2.3%, 2.2%. Basically, if you can look at it, you can see that this is an uptrend. It started from 2%, 2.1, 2.3, it went back to 2.2, which is above 2.1. Basically, what it tells you is that the GDP is in an uptrend, and that says to you, accompanied with the unemployment, the CPIs telling you about the future, is that the currency will appreciate. The currency is responding well to macroeconomic reports. In other words, the United States currency will appreciate. Because of that, Chair Powell did what we see here. He held rates in January the 28th. He held interest rates at 3.75%, and that supports the growth in the currency. And those who say they don't understand how I look into macroeconomics, this is the basic framework that I go into. And this is not everything, but this is the basic framework that I go into. And holding rates is uh, a bullish move in a currency. It helps the currency appreciate because the hedge funds are going to buy the currency that holds rates. Remember, we're in a recession. In a interest rate cutting cycle. When we hold interest rates, the currency is bullish. When we cut interest rates, the currency is bearish. And the opposite will happen in a hiking cycle. This is an interest rate cutting cycle. And because of the economic reports that you see here, Fed Chair Powell had to do something else. I'm having a few changes here. I don't know what happened. I'm trying to move into the CMA group. So here, what they did in the Fed Watch tool, previously we had our interest rate cuts at 17th of June 2026. This is where Fed Chair Powell was expecting to cut rates, but because of those positive economic reports in inflation and the booming currency, unemployment rate keeping the drop, and GDP being balanced and holding rates, basically what what Fed Chair Powell says is I was expecting to cut rates further in June, but for now, because of the stability in the macroeconomic reports in inflation, he's expecting to cut rates further into the year. Instead of cutting them on the 17th of June, he went back to the 29th of July 2026. So previously it was on the 17th of June, the first rate cut, and the second rate cut was on the 16th of September 2026. So they moved everything further to the right because of the future growth perceptions in the consumer price index and all of those economic reports that I showed to you. So here we move toward July from June, which is 25 basis points interest rate cut. And most economies are actually moving out of an interest rate cutting cycle. They're already talking about hiking rates. So we're actually the global economy is recovering from this recession, and we are moving into the hiking cycle. We're moving from the holding pattern to a hiking cycle. So here we have interest rates moved from June to July 29th, and from September the 16th to October the 28th. And this supports a bullish currency, which means we can go long on the US dollar until the 17th of June. And the macroeconomic reports may change. We might move to the first interest rate cut for 2026 to the 16th of September, and that means we'll be holding the US dollar bullish for more than 6 months. So many people were asking me, how do you know where to take profit? Well, this is where I know how to take profit, but this is only the Fed Watch tool. But other currencies, I use the economic reports that you see here to see whether I should cut rates or not. Now, previously we spoke about the pound, and the pound was actually telling me that it will go bullish for some time. I will try to bring in the JPY. Here we have the CHF. I'll try to bring in the JPY before we end the video. and we held longs. The entry was here. We went to the 50% feed. We went to the previous shoulder, this previous shoulder, and we took the bullish move. It almost reversed. I almost lost hope here, but the currency actually pumped in my direction and I took profit. But I was expecting the currency to actually break above here, but it gave us this crazy pullback, which I did not trade. And it actually went to break above here. I don't think it did break. Let's use this horizontal line to see whether it broke or not. You can see that it did not break this high. So I did not trade this whole move and that other moves. I only traded this and I took profit. So we'll see what actually the pound is bearish. This was a temporary bullish move that we've looked into, that we saw in the pound. And the pound also held rates, and that's why we bought it, but I was not expecting it to move sideways in this fashion. This is the 1 hour time frame. Let's give you the daily, and you will see that on the daily, you did not really get that much of a move. Perhaps because I'm a long-term trader, this thing might be gradually moving higher. But this is just an interest rate hold in the pound, and that is showing itself here. It might move, but I'm not expecting it to move that high because I'm expecting shorts in the pound. Looking into macroeconomic reports, the JPY was actually doing us the favor that we could not get from the CHF. And I always spoke about this is the daily time frame. I always spoke about the CHF being a very, very bullish currency. It's a powerful currency. Actually, when the euro gains a little bit of strength, the CHF does the same. So it's a little bit difficult to uh, uh, buy to sell the CHF, and easier to sell the JPY. So this is the beautiful move that we had that we couldn't get from the CHF. This is the 1 hour time frame on the CHF, and you can see that we did not get to lend. We did not get the actual lending on the 23.6, this green line over here, the 23.6. We did not, it did not even touch it, and it reversed all the way up there. What is important, okay, normally JPY trades don't reverse because the economic divergence is huge, and that's the reason why it rarely touches the 23.6. So it took off all the way up there. What is important is that it moved trades into profit. That's the only important thing that we look into here on this trade. Let's look into other trades. This is the GBP USD. We're actually being compromised because the pound also held rates, and we're expecting uh, the US dollar to gain strength more compared to the British pound. The reason why we expect that is because of macroeconomic reports. We were looking into the performance macroeconomically on the US dollar and the pound. So in the pound, what is happening is that unemployment rate is gaining, is increasing. The consumer price index, all of these economic reports that I was showing to you here on the pound are actually doing the opposite. These gains are dropping lower, and unemployment rate is rising in the pound, which is the opposite of what is happening here. And these gains on the GDP are actually below the 2% benchmark. And that's at, even though they held rates, but the currency is uh, not necessarily that much bullish. So I don't have the time to show you what the macroeconomic reports on the pound are, but I'm expecting this currency to actually return to the 23.6, the previous shoulder, and drop lower. Thank you guys. I'll see you on the next episode. Goodbye.